Hello everyone, welcome back to Boss Economic World, the only place on the internet where we peel back the fancy suits, ignore the jargon, and look at the cold, hard cash to tell you what's actually happening to your money. I'm your host. Today is December 3rd, 2025. Grab your coffee or your peppermint tea, since it's getting cold, because we need to talk about Europe. If you've been reading the headlines this morning, you've probably seen a lot of patting on the back coming from Frankfurt. The European Central Bank is acting like a pilot who just landed a plane with one engine on fire, telling the passengers, see? Smooth landing. But is it? Here is the headline news: Euro area inflation has ticked up. Just a little bit. It's sitting at 2.2% for November, up from 2.1% last month. Now, the mainstream media will tell you, oh, it's just a blip. We are basically at the target. But here at Boss Economic World, we don't deal in basically. We deal in the truth. And the truth is, the ECB has hit a wall, the interest rate cuts are likely over for a while, and the economic map of Europe is fracturing in a way that should make any investor nervous. Today, we are going to dissect the 2.2% lie, analyze why Germany is sweating while Spain is partying, and explain why your boss probably isn't going to give you that massive raise you were banking on for 2026. Let's get into it. Let's look at the numbers. You know I love the numbers because numbers don't lie, only the people interpreting them do. In November 2025, consumer prices rose 2.2% year-on-year. This beat the Bloomberg median estimate. It's slightly hotter than the 2.1% we saw in October. Now, you might say, boss, 0.1%? Who cares? That's a rounding error. Here is why you should care. For the last 9 months, the Eurozone has been hovering dangerously close to the ECB's holy grail target of 2%. Everyone got comfortable. The market started pricing in this idea that inflation was dead, buried, and we were going back to the era of free money. But look at core inflation. Remember, core inflation is the index that strips out the volatile stuff like food and energy. It's the stuff that actually dictates the cost of your lifestyle, your haircut, your insurance, your rent, your streaming subscriptions. Core inflation didn't move. It is stuck at 2.4%. Why is this number haunting us? Because in a healthy economy, headline inflation fluctuates, but core inflation is supposed to drop when you hike interest rates. We spent the last 2 years watching the ECB hike rates to the moon, and then this year, they slashed them 8 times, quarter point by quarter point, down to the current 2%. And yet, the core price pressures, specifically in the services sector, are edging higher. This tells us something very specific: the easy part of the fight against inflation is over. The part where supply chains unkinked themselves after the pandemic? Done. The part where energy prices stabilized after the initial shock of the Ukraine conflicts? Done. Now we are in the trench warfare phase. This is where businesses refuse to lower prices because they've gotten used to the margins, and consumers keep paying because they've accepted that $7 is the normal price for a cappuccino. Let's talk about the grand architects of this situation, the European Central Bank. Last week, ECB President Christine Lagarde went on TV. She looked calm, composed, very chic as always. She said, and I quote, "We're in a good position given the inflation cycle, which we've managed to get under control." She added that rates are set correctly. Let me translate central banker speak into human speak for you. When a central banker says rates are set correctly and they are comfortable, it means we have absolutely no intention of doing anything for the next 6 months. Investors and economists have finally woken up to this. The consensus is now unanimous: the ECB is going to keep the deposit rate at 2% when they meet later this month. Why? Because 2% is what economists call the neutral rate. It's the rate that neither stimulates the economy nor restricts it. It's the Goldilocks zone. But here is the problem with Goldilocks: she eventually gets eaten by bears if she stays in the house too long. The ECB has slashed rates from 4% down to 2% in a frantic streak of 8 cuts. They did this because they were terrified of a recession. Now, they are terrified of reigniting inflation. So, they are freezing. Vice President Luis de Guindos came out on Monday, just yesterday, and said, the markets are pricing instability, although, obviously, given the level of uncertainty, we are open to adjusting it. Open to adjusting it. That is the ultimate hedge. It's like telling your girlfriend, I am committed to this relationship, but obviously, if I meet a supermodel, I am open to adjusting it. The ECB is telling you that the era of cheap money returning quickly is a fantasy. If you are holding out for a mortgage rate drop in Q1 2026, don't hold your breath. The 2% floor is lava. Now, this is the part that fascinates me, and it's the part that generic news anchors gloss over. When we say Eurozone inflation is 2.2%, that is an average. But if you put one hand in a bucket of ice and one hand in a bucket of boiling water, on average, you are comfortable. In reality, you are in pain. The Eurozone is currently in pain because of divergence. Let's look at Germany. The traditional engine of Europe. The industrial powerhouse. What's happening there? Inflation quickened. Germany is currently suffering from what I call the industrial hangover. Their energy-intensive manufacturing base is still struggling with costs that are structurally higher than in the US or China. Yet, prices are rising. Why? Because the German labor market is tight, and unions have been demanding and getting hikes to offset the last 3 years of pain. Now look at Spain and Italy. Inflation there is easing. Spain is looking like the golden child of Europe right now. Why? Because their economy has pivoted heavily toward services and tourism, which recovered faster and are less sensitive to the global energy spikes than German chemical plants. Plus, base effects from energy subsidies dropping out played differently in the south. France? Held steady. France is just trying to keep the lights on amidst its own fiscal drama, which we will discuss another day. This divergence is a nightmare for the ECB. Lagarde has one steering wheel for a car where the front wheels are stuck in mud and the back wheels are spinning on ice. If she cuts rates to help Germany, she overheats Spain. If she raises rates to cool services inflation in the south, she kills German industry. So, what does she do? She does nothing. She holds at 2%. And that is why the pause is the only play left in the playbook. Let's move to the topic that hits your bank account directly: wages. One of the main reasons inflation is stuck above 2%, specifically that core inflation at 2.4%, is the services sector. Think about it. What is the main cost of running a consulting firm, a hospital, or a restaurant? It's people. It's labor. For the last 2 years, workers across Europe have been saying, hey, inflation went up 10% cumulatively, and my pay went up 2%. Pay me. And companies did. This is called the catch-up phase. However, the ECB has a proprietary tracker of collective bargaining agreements, basically a spyglass into future union deals. And here is the breaking news: the tracker points to softer salary increases ahead. This is crucial. The wage price spiral, the terrifying loop where high prices cause high wages which cause higher prices, is losing momentum. This is good for inflation. It is bad for you if you were hoping for a 10% raise in 2026. The corporate sector has realized they cannot pass on any more price hikes to consumers. We have hit the ceiling of pricing power. You, the consumer, have finally started saying no. You are buying the store brand pasta. You are skipping the second beer at the pub. Because companies can't raise prices as easily, they must protect margins. How? By being stingier with raises. So, the logic dictates, wage growth slows - services inflation cools - ECB feels safe. But that process takes time. And until it happens, we are stuck in this uncomfortable 2% interest rate limbo. Here is a nugget that most people missed in the report. The upcoming December meeting isn't just about rates, it's about the projections. We are getting the first official glance at 2028. Why does 2028 matter today? Because economics is a game of expectations. The previous ECB models predicted a dip in inflation below 2% soon. But now, there is a wrench in the gears: the European Union's new carbon pricing system. This was supposed to kick in aggressively, forcing companies to pay for their emissions. However, Brussels, sensing the political anger across the continent, has delayed parts of it. This delay creates a weird statistical anomaly. It might temporarily lower inflation, but it creates a cliff edge later. Several ECB officials have warned, don't trust the dip. This is what we call greenflation. The transition to net zero is expensive. It requires massive investment in grids, batteries, and new tech. That investment requires capital and materials. That drives up prices. So, even if the old inflation goes away, the new inflation is waiting in the wings. This is another reason why Lagarde isn't dropping rates to zero. She knows the structural floor of inflation is higher in the 2020s than it was in the 2010s. Finally, we have to look outside the window. We cannot analyze the Eurozone in a vacuum. Vice President de Guindos mentioned the unknowns in the international geopolitical environment. That is diplomatic code for, we are terrified of what's happening in the Middle East and the trade policy coming out of Washington. It is late 2025. We are looking at a fragmented global trade system. Supply chains are no longer just in time, they are just in case. If shipping routes in the Red Sea get blocked again, or if the US imposes a new universal tariff, import prices in Europe go up instantly. Europe is an open economy. It relies on trade. This is why the markets are pricing in stability for now. They are assuming the status quo holds. But as we know, in the 2020s, the status quo has a lifespan of about 15 minutes. If oil spikes back to $90 per barrel because of a geopolitical flare-up, that 2.2% inflation becomes 3.5% in a month. And if that happens, the ECB won't be cutting. They might even, heaven forbid, have to talk about hiking again. So, let's wrap this up and restore the full picture. What is the truth behind the events of December 3, 2025? 1. The pivot is over, the aggressive rate-cutting cycle is finished. We are now in the plateau phase. Expect rates to stay at roughly 2% through 2026. 2. Cash is no longer trash, but it's not king. With inflation at 2.2% and rates at 2%, your real return on cash in the bank is basically zero. You aren't losing 10% like you were in 2022, but you aren't getting rich holding deposits. 3. The soft landing has a rough runway. The economy is gathering momentum, but it's uneven. If you are in the services sector in Southern Europe, things look great. If you are in manufacturing in Germany, tighten your belt. 4. Don't bet on the wage spiral. The days of massive salary jumps to match inflation are ending. Focus on job security over aggressive hopping in 2026. The ECB is trying to pull off a magic trick, waiting for inflation to die completely without killing the economy. They are currently freezing in place, hoping that doing nothing is the best form of action. For you, the investor, this means volatility is low, but opportunity is scarce. The easy money from the rebound trade is gone. Now you have to be selective. Look for companies that have pricing power even when inflation is sticky. Look for sectors that aren't reliant on cheap debt, because debt isn't getting cheaper anytime soon. Inflation is like a guest who has put their coat on, said goodbye, but is still standing in your doorway talking for 45 minutes. It's technically leaving, but it's still taking up space. Until next time, keep your eyes on the data, ignore the political noise, and remember, in the boss economic world, we don't hope for the best, we calculate for the worst. I'm the boss. See you in the next video.